just a quick introduction at my end. I'm Dhaval Kapadia. I head the investment products at Shriram Wealth, and of course, I've got my colleague with me out here, Himal, as well. So today, of course, this webinar, we've set this webinar up with Prashant to sort of get a sense of what's happening globally. Of course, the news is all out there, and most people are tracking Trump's tweets more than anything else, right? I mean, to figure out where things are headed. But we thought we'll get a broader perspective, from Prashant, who's obviously one of the most sort of experienced investors and fund managers, that the country has, and with vast experience across different market cycles. So we thought, this is an opportune time to sort of get his thoughts on one is obviously, how, which is partially is difficult, right? How this scenario is planning out, but more importantly, in terms of what sort of impact does he really see on the Indian economy and markets sort of going forward as well. So before I hand over to Prashant, just a quick sort of introduction. I think most people are aware of, are familiar with Prashant, but just for a quick sort of background, of course, Prashant is the founder and CIO of 3P Investment Managers. Prior to launching 3P in 2022, he was the chief investment officer at HDFC Mutual Fund, obviously from 2004 to 2022. And during his tenure at HDFC, the fund's assets grew from approximately 3,000 crores to about 4,40,000 crores as such. And of this, approximately about 2.3 lakh crores was in equity or equity oriented funds. And of course, Prashant has the distinction of being the only fund manager in India and one of the few globally to have continuously managed a single scheme for over 28 years, right? And this fund was the HDFC Balanced Advantage Fund, and earlier known as the HDFC Prudence Fund. It was a hybrid equity fund, which delivered a CAGR return of about close to 18% from Jan 94 to July 2022 versus a Sensex CAGR of about 9.6 odd percent or so. So clearly, of course, as we said, Prashant is a seasoned investor, seen different market cycles, and not just seen those cycles, but he's called many of those cycles on time as such. So without much ado, I'll hand over to Prashant to take it forward from here. And just one final point is that do feel free to post your questions on the Q&A box. We'll take them up later in the session as well. So over to you, Prashant.
Thank you, Dhaval, and very good evening to all of you, friends. Thank you for joining this session. I'll speak for less time so that we have adequate time for Q&A. In fact, 2 days back, we sent out a note which was titled that this too shall pass. And we clearly had no inkling of what President Trump will tweet. But that one tweet, I think, has improved, has changed things. What could have probably taken few months, it has happened very fast, but still there could be uncertainty. We don't know. So I think the India's economy is pretty well placed, and we have been doing extremely well. We continue to grow pretty well. Government has taken a lot of steps to improve the physical, digital infrastructure. A lot of things have improved for businesses, and government has played a very proactive role in supporting manufacturing in India. And we have been growing close to 7% a year with fairly low both current account and falling fiscal deficits. So I think the structural tailwinds for India are pretty strong, and there is every reason to be quite optimistic on India's economic growth. I think in the bank balance sheets, the corporate balance sheets in India are extremely healthy. But for the oil prices, there was actually no worry. Now, this war clearly has come as a surprise, and India has sensitivity. It is vulnerable to a spike in oil prices. The good thing is that the sensitivity towards oil is much lower than it used to be in the past. Our oil imports to GDP has reduced considerably in last 10 years. And that is why our sensitivity to higher oil prices is much lower. Also, what has happened post-COVID through remote working, there has been a sharp increase in the number of global capability centers, the GCCs. They employ close to 2 million people, and this has propelled the service exports out of India it has accelerated the service exports out of India, and therefore our current account deficit has been running around 1.25 percent, which is quite low. In the past, our current account deficit used to be between 2 and 3 percent. So this is what has improved India's ability to withstand a sharp spike in oil prices. Also, what has happened last 2 years, that the because equity markets were doing so well and large pockets of the markets were pretty expensive. Therefore, many multinational companies and private equity funds thought it proper to sell down their stakes in India, their ownership of stakes in India. And therefore, the outward or the remittances or repatriation of FDI was pretty large out of India. And therefore, the net FDI into India had fallen to close to zero last 2 years. So while on one hand oil prices will have gone up, they will put some pressure, but on the other hand, since capital markets have come down and in almost 6 or 7 issues out of 10, investors are making losses of last 2 years, I think the going ahead, the appetite for people to buy new issues is considerably reduced, and therefore the outward FDI movement would be sharply lower. So, on one hand, the oil prices, oil import bill may go up, and on the other hand, the outward movement of FDI will come down. Therefore, net, I think even if oil stays at $100, it is will be a quite manageable situation. Even if it stays there for a year or two, I don't think, given our foreign exchange reserves of $700 billion, it will be a challenge to meet this at all. So we should continue to remain in very good shape in terms of balance of payments, foreign exchange reserves, etc. Now, coming to markets, last 18 months, markets have been flat. Actually, they are down 10%. If you see where index was in September 24, and therefore, because of this time and price correction, the multiples of the markets have come down sharply. The India's premium over emerging markets, which had gone up to above average levels, has since moved to has been reverted to normal levels. Markets are trading close to 17 and a half times 1 year forward earnings, which is pretty reasonable, even if you bake in just 12% earnings growth. Also, in India, there has been one very simple, one very important change in markets. If you see last 1 month, last 18 months, foreigners have sold billions of dollars of stock. Yet Indian markets have been remarkably stable. I mean, if you absorb 30, $40 billion of selling and you are down only 10%, and that too because oil prices have gone up so sharply, it tells you a lot how resilient these markets have become apart from the economy. So I think the Indian markets are more influenced, more driven by flow of local capital, which is not just large, but it is sustainable. And since now the primary markets capital raising will be much lower, which is the biggest change to my mind. Everyone talks about foreign flows. When will foreigners come back? I say, look, that matters to a much lesser extent. If primary markets start raising a lot less capital, then all the money that is going to mutual funds and others will get deployed in the secondary markets. So I think that's a very big positive for these markets. And we have seen time and again, whether it was 2001, 2007, and Lehman crisis, 2020 COVID, tapering in 2013-14, we have seen time and again that good valuations are available only when there is some challenge in the environment. And when there is a challenge in the environment, clearly there is fear. And therefore, great investments are often made in very adverse environments. But it is not easy to invest at times like these because we are thinking 1 week, 2 weeks, 1 month. The key is to think 1 year, 2 year, 3 years at times like these. So I think uh, the current uh, fall in markets, which is because of a war being fought in Iran, should have no direct impact on India's economy, but through the oil prices, which again I think is pretty manageable. It will impact some companies in terms of margins for 1 or 2 quarters. I don't think the impact will be longer than that. Let us not forget that in 2000, oil prices were $25, and by 2008, they were $140. Yet India's economy grew 7% per year over that 7 year period. And so, if you could handle such a big spike for over 7 years, I think we can handle a $30-40 spike, even if average is there for 1 year. Hopefully, things could come back to much lower levels. So, I think this is a pretty manageable situation. And I think I would use this sharp fall in equities to add to my exposure to equities, provided it matches your risk appetite and provided you are tolerant of volatility and provided you have a 1 to 3 year view. The higher oil prices could lead a bit to higher inflation. They could lead to slightly lower currency. But an equity investor should not worry about these things. Equities are a hedge against inflation. And I mean, we know rupee was 20 rupees, 40, 50, 60, 70, 80, 90. So rupee has been depreciating against global currencies because the inflation in India has been slightly higher than the rest of the world. But then equities give you returns which are equal to roughly the real growth of the economy plus the inflation. So if inflation goes up for 1 year, let's say by 2%, 3%, what is inflation? It is basically the increase in selling prices for goods and services by companies. So if inflation goes up, it will be passed on to the consumer. And companies' turnover and profits tend to grow in line with inflation. Therefore, an equity investor should not worry about slight currency depreciation, slight hike in interest rates, slight hike in inflation. In any case, these are likely to be transient. Once you have passed on the higher fuel prices to the consumer, that becomes the new base. And in subsequent years, inflation can come down again. So, and in a way, it is good what President Trump has tweeted that they have ceased or postponed these hostilities for some time. We don't know what the outcome is. So, but what is happening today is telling you clearly why equities are so volatile. And this is what I always say that investors need to distinguish between risk and volatility. Most people say that equities are risky. I feel it is better to say equities are volatile and risk in equities reduces with time. What is risk? Risk is when you have a permanent loss of capital or returns. If you invest sensibly, if you buy decent companies or good mutual funds, and if you don't pay a crazy price for these investments, equities are not risky. Over time, they create significant amounts of wealth. Sensex now has a history of 47 years. 100 Sensex has become what, 75 or 1000, whatever. And in this period, we have seen so many wars, so many new governments, so many periods of high interest rates, so many periods of high oil prices. It's so many crises we have seen: Lehman, Brexit, tapering, 9/11, etc. Yet the equity economy has continued to grow, Sensex has continued to compound, and equities have created wealth. So I think equities are more volatile and less risky over long periods of time. And that is why to invest in line with your asset allocation to invest in line with your risk profile is extremely important. So I would say that uh, the India is in a fairly strong position to deal with this current spike in oil prices. We have seen this many a times in the past, and then the spike was actually much bigger. Our current account deficits were much higher. Our foreign exchange reserves were much lower. Today, we are in a far stronger position to handle this spike, whatever course oil prices take. The markets have seen considerable time and price correction. And I would urge you to try and increase exposure to equities at this point of time, as we wrote 2 days back. And I will request Dawal to share that note with you after this call. And I'm happy to answer any questions that are there.
Sure. Thanks, Prashant. I think that was a good sort of overview of your thoughts, I mean, and your views as such. So I think it was quite useful to get that perspective. I think, uh, Himal, do we want to look at the questions that have come through?
Yeah, I think people will start posting questions, but we already have a few of them. So maybe to start off with, there's this question which suggests, and it's a twofold question ideally, that if there is an existing investor who's already fully invested, how should we go about changing the portfolio, or how the review of the portfolio should be happening on that front, or for a new investor, where all or what asset classes would be ideal at this point of time?
So I think that's a very general question. So if you are managing your own portfolio, if you are fully invested, then clearly you cannot increase exposure to equities. The portfolio review, I mean, I don't think I can add much value to it. If you are investing in a mutual fund, then the manager will do it for you. I would like to say only two things here, that our investment strategy and what I have seen works is that invest only in good companies that you understand. Number one. And number two, do not pay a crazy price even for good companies. And once you have built a portfolio of co- good companies which you understand, and you have not paid a crazy price, then if you are patient over time, this portfolio creates wealth. Second, I don't think the we can underestimate the need to remain diversified in equities. It is extremely important, and I've seen typically in direct portfolios, people overexpose themselves to a single stock, which could be very risky. What if you had invested in an airline stock at times like these? What if you're disproportionately exposed to an oil marketing company? What if you were disproportionately exposed to the tobacco sector when government sharply hiked taxes? What happened if you were overexposed to the one of the best bank in the country? So I think even good companies can face challenging environment, challenging situations. So therefore, the need to remain diversified in equities is paramount. So that was on the. I would also like to say that by and large, I feel large caps are much better placed in this market than a small and mid caps as a category. Now, 1 in 10 companies in small mid caps can offer good values. It could be a high quality company. But as a category, I think large caps are offering better value in this market. So that was the first question. Regarding the second question, I think it's very broad based. And all I can say is whatever portion of your money you don't need for the next 3, 5 years and on which you can tolerate volatility, that portion of your wealth should be invested in equities. And the balance you should invest in fixed income.
So what about gold and silver or any other commodities as asset class?
Well, these are, see, I am not too familiar, not, I don't understand these asset classes well, but what I have seen when asset classes become extremely popular, they are unlikely to be good investments. And the sharp increase in prices that we have seen in gold and silver, and the sharp retail interest that we have seen in gold and silver, is telling me from my past experience that they are less likely to be great investments at this point of time. Of course, I think since gold is a has very unique characteristics, I think some small exposure to gold with a very long term view, 10, 20, 30, 50-year view, I think Indians have been doing that, and that I think is a sensible allocation. Silver, I would be a lot more cautious. It is far more volatile. It is far more speculative. Yes.
The next question is about what sectors are best to pick up in the current scenario of the market, according to you.
So I think people always focus on sectors. They always focus on companies. They don't focus on the asset class. And if you simply bought the Sensex, you made huge amount of money. Huge amount of money. So there are funds in India where NAVs have gone up 100, 200 times. Right. So I think the key is your allocation to equities and how long you hold a portfolio of good, strong, reasonably valued companies. But in terms of sectors, I think large caps are better than small mid caps. And I also feel that banks continue to look good. NBFCs, if things don't deteriorate, they're looking good. I would say by and large, the entire Nifty is looking good. So even sectors like FMCG and retail, which were terribly expensive, they are still expensive, but they are not so expensive. So otherwise, life insurance, telecom, tobacco, automobiles, uh, uh, pharmaceuticals. So I think most sectors are offering value. And at this point of time, rather than buying one or two companies, I would say you should buy large caps, remain diversified. You can simply buy Nifty index, could buy fund, or you could put a portfolio of diversified companies yourself. See, I have spent about 35, 36 years in markets, yet we run a portfolio of 40 companies. Why? So, because in equities, diversification is important. So, in the last 4 or 5 months, you have seen so many companies, high quality companies, the best quality companies, come under stress for a different reasons, whether it's an OMC, airline, tobacco, bank. So, what is this telling you? That one way of minimizing your risk in equities is to remain diversified. So, I would say do not over concentrate on one or two sectors. Yes.
The next question is, given the context of what has happened in the last few days, what would be your deployment strategy as far as liquidity is concerned? Do we deploy the entire money at one go, or we time the market, or we just, as you mentioned, purely that if you find value, you just go ahead with it?
We cannot time the market. So, can anyone tell me whether crude is going to $90, $80, or $150? No one can tell that. So, how can you time these markets? So, I think short-term timing is not possible in markets. That's the very nature of this asset class. But today you are getting good value from a 1 year, 2 year perspective. So, I think if you can think few years, these are good levels to participate in. These are good levels to invest in. If you are investing a large part of your wealth in equities, in next at this point of time, it would be better to phase it out over a few weeks. If you are investing 2% of your wealth in equities, you can buy all of it at one go. If you are investing 20%, 30%, then I think it's always a good idea to phase it out over some time. In these conditions, since markets have already undergone uh, reasonable time and price correction, I don't think we should take 6 months or 1 year. I think we should get invested in the next few weeks. Yes.
The next question is, I think you already did mention about mid and small caps not looking apt right now, but what is your view over the next maybe 5 to 7 years?
See, small mid caps is not about, it is about security, it is about stock picking. And this is what, see, in COVID, what happened? The large caps fell 30%, 100 became 70. The small mid caps fell by 70%, 100 became 30. And as things normalized, in 6 years, the index has should have doubled. So large caps went from 70 to 100 to 200, and small mid caps went from 30 or 40 to 200 over the next 5 6 years. So, and most investors today in the markets have joined the markets after the uh, COVID. Pre-COVID, there were 3 crore demat accounts. Today, there are 13 crore demat accounts. So most of these investors, because of the sharper fall in small mid caps in COVID, much lower base, have experienced much higher returns in the small mid caps. And that is why they feel that small mid caps is the way to go. I don't think that is the case. The small mid caps are, once again, small mid caps, I think, will create similar amounts of wealth as large caps. I don't think these are cheap. If at all, they are slightly expensive. So unless you are a stock picker in small mid caps, I don't think a category based investing will work here.
Okay. There are a lot of questions coming for diversification into international markets. Your views on where can one diversify in the international market? Should it be developing markets or developed markets? Or for you, India is the best?
In every second country in the world is in trouble for different reasons, right? So India offers you socio-economic, political stability. It offers you the best growth prospects in the world right now amongst top 20 economies. India's volatility of growth is the lowest, and markets have sharply corrected. So, at least at this point of time, I think India is a very good investment. I am also not an expert on markets outside India. So, let me not comment on that. Yes.
Okay. You did answer that the banking sector looks to be a little bit attractive. There is a specific question related to IT. So, is it a good time to buy into IT, or do we have those kind of tools that can fight against the AI sector, which is booming elsewhere?
See, equities are a uncertain asset class. We are dealing with future business outcomes. So you will not get perfect answers. That's why the read to remain diversified is extremely important. I think IT industry is very competitive, very well placed. They've handled many technological changes in the past, many technical cycles in the past. They've handled well. I think AI will lead to some deflation, lower costs, productivity gains. But I also feel that as businesses, as enterprises, they adopt AI, the reduction in budgets of existing work will get offset by demand for more work. So I feel that this sector is unlikely to be a negative growth sector. That's what I feel. Multiples are quite reasonable, and the dividend yields are pretty good, but it's a very slow growing sector. It grows 3, 5, 7% a year. So, and it's a B2B sector. Margin cost savings typically get passed on. So I would say, I mean, in a diversified portfolio, some exposure can be taken. But I don't think I would set any significant return targets on this sector unless we see acceleration in IT specs. Yes.
Okay. Um, So there have been a lot of questions being asked on the political front about the war. Would you want to comment on that?
See, India is not a party to this war, right? How does this war impact us? It's extremely unfortunate because many families will get destroyed, many people will lose their lives, a lot of hardships for countries at war. But India has no direct impact. The only way India feels the impact is through oil prices, through maybe fertilizer prices, gas prices. So I think I've already addressed that. This is not the first war that is being fought. Wars have been fought for thousands and thousands of years. So it is unfortunate, but that is the reality. That is how people are. So I think this war should not have any material or lasting impact on India. And that's why I said earlier that I would be a buyer in the current uncertainty.
I think there are a couple of questions. Sorry. Yeah, I think there were a couple of questions around again sectoral views on like the defense sector or the health sector. I mean, pharma and health, of course. So, would you like to sort of comment on those?
Our pharma is very bottom up. Every company is unique. Defense, I think, is a very good sector from a business point of view. I think the it is not cheap. It was a very popular sector 1 2 years back. So I again go back to that. What is very popular seldom is a good investment. The stock prices have come off. These are good companies, but let us not forget most of them have a single buyer. What happens if your oil subsidy, fertilizer subsidy goes up very sharply? Maybe your defense budgets will get pushed out. So I think, see, in this market, there is no deeply undervalued sector. There is no deeply undervalued sector. The dispersion in valuations is quite low. So I would say, rather than focusing on individual sectors, this is a time to focus on your asset allocation towards equities. That is where the opportunity is, yes.
Okay. And your specific views on the USD against the rupee?
Also, I don't think we can answer that. It depends on oil prices. If oil goes to 150, it stays there, it would lead to significant pressure on the rupee. If oil comes back to 80, the pressure is off. So, see, but the key is if rupee depreciates, how does it impact? Equities is a pass through for currency depreciation. Rupee was 10 rupees to a dollar maybe 30, 40 years back. So why do equities give you 12%? That 4 to 6% a year is inflation. That inflation is because of currency depreciation. So I don't think we can forecast currencies. All I would say, whichever way currency moves, your long-term returns of equities of Nifty should be around 11-12%. They are unlikely to be higher than that. Is.
Your views on alternate asset classes like REITs and InvITs?
Well, it is again very company specific. See, the asset characteristics are known, but you need to understand that what assets are there, what is the yield, what price you are paying, what future pipeline of assets will come. So I don't think you can have a top-down view. I mean, these are good asset classes. They have a very good characteristics of partly of debt, partly of equity. But the key is to analyze, to understand each of these companies as a security.
Okay. Just a few more questions. There's one specific one which asks on if the time and price correction is already undergoing, where should the tilt on the portfolio be towards growth stocks or value stocks?
there is no difference between growth and value. If growth is higher, then one is willing to pay a higher P for that. Growth is lower, the P will be lower, fair P. But the key is not to overpay related to the growth. An 80p can be cheap and a 10p can be very expensive. So I think this whole debate of growth versus value is not the correct debate. The definitions of these stocks they keep on changing. So I would say focus on the ability of a business to win, focus on the quality of the company, and the price that you pay, whether the growth is high or low, should not be unreasonable relative to the growth. In any case, very high growth rates of individual businesses are not sustainable for long periods of time.
I think
Okay.
there's another question which is sounds interesting is that given that markets are increasingly driven by global liquidity, of course in our case domestic liquidity as well, and geopolitics and passive flows, where do you see the next decade of alpha sort of coming from? I mean, given that all of these factors are playing bigger roles.
Well, I think Indian markets should be increasingly driven by local capital and not by global capital. So that is very, very clear. And that is why the volatility of markets has gone down. So I think the 10 years is too long a time to say where will alpha come from. And as we know, many active managers are also not able to outperform the markets. So I don't think I can hazard a guess where will the alpha come from over next 2 years. But I think currently large caps look better than small and mid caps. And I would say the outlook for banks is quite decent unless the economic conditions sharply deteriorate. So if you believe this war is ending, if you believe the oil prices will stabilize at not too high levels, I think banks are offering fairly good value. But once they move whatever percent, then it may give you alpha for 3 months, 6 months, 1 year, 2 years. But I don't think one can say anything for the next 10 years. In my opinion, there are hardly any multi-bagger exponential return kind of opportunities in these markets.
So regarding to banks, there have been a lot of questions regarding whether HDFC Bank is a good buy at current levels. Would you
I
like to
don't want
comment
to
on that?
comment on individual companies, but I think
Sure.
it's an unbeatable franchise. And experience has told us that when great businesses are passing through a challenging time, investments made around those times, chances are they turn out to be great investments.
Any comments on private versus PSUs on the banking front?
Buy strong banks, whether they are PSUs or private, doesn't make it. There are weak private banks, there are weak PSU banks. There are many private banks which have suffered deeply in the past. So it is not about PSU versus private, it is about strong versus weak.
Dhawal, I think we've covered most of the questions. Do you have anything else?
I think there's one question that I'm seeing here. I mean, again, it's there, so we are sort of putting it out. Is that are you seeing any sort of sunrise kind of sectors? I mean, we've spoken a lot about traditional sectors. I mean, it may sound a little bit cliche, but are you seeing any such sort of sectors
This
as well?
this quest for multi-baggers is uh, damaging in the long run because people invest on stories. Yes, EVs are an emerging sector. Solar is an emerging sector. But the key is do only you know about that or the whole market knows about that? If the whole market knows about that, maybe it is very expensive. Maybe it is extremely popular. So I would say that in this market, there are no obvious high growth sectors that are available at attractive valuations. This is not a multi-bagger market. Please remember, index has fallen 10% only. It is not that it is down 30%. Because when you have sharp downfalls in the markets, that is when you will see some high return opportunities. This is a compounding market. It can offer you a one-time up move of 5-10% if and when this war thing stabilizes. And beyond that, it will compound around 11-12%. I don't think this is a market where I am able to identify any mega return opportunities.
I
Yeah.
think we are done with the questions. Any
Yeah.
any last concluding comments from you, sir?
All this will pass. Think long term, be tolerant of volatility, focus on asset allocation, take advantage of this opportunity. And pessimists sound smarter, but optimists make money.
Thank you. Thank you so
Yeah.
much for being here with us. I'm sure we have an audience which is much more educated at the end of the webinar and much more, I would say, in safer hands, and now much more clearer of thoughts as well.
No pleasure. Thank you.
Yeah.
Thank you, everyone. Bye.
Thanks.
Thank
Thanks,
you.
Prashant. Thank
Bye.
you.
Bye.
Thank you everyone for joining in.